The transactional net margin method, or TNMM, evaluates a company's transfer pricing by comparing its net operating profit margin to the margins earned by independent, uncontrolled companies. But a surface-level comparison often masks a critical reality. Two companies can have identical physical operations, identical product lines, and even identical gross margins, yet generate completely different levels of underlying profitability. This discrepancy is usually driven by a hidden funding gap underneath one of the facilities. It occurs when these supposedly identical companies enforce entirely different credit terms with their customers or maintain disparate inventory levels. To achieve actual comparability under OECD guidelines, analysts must execute a specific mathematical adjustment to neutralize this financial drag. Submitting unadjusted margins during a transfer pricing audit leaves a multinational exposed to massive compliance liabilities, simply because the time value of money was ignored. Consider the mechanics of trade receivables. Providing a customer with 60 days to pay an invoice is economically identical to extending a free, unsecured line of credit. The company carrying those receivables faces a strict financial consequence. It must either borrow external funds to bridge that 60-day gap, paying interest on the debt, or it must sacrifice the investment returns that its cash would have otherwise generated. Maintaining excessive inventory creates an identical drag. It traps capital on the warehouse floor, turning liquid assets into static, immovable stock that requires constant funding. Accounts payable function in the exact opposite direction. Carrying high payables allows a company to delay paying its bills, effectively using its suppliers as a free, short-term funding source. To account for these variances, the OECD Transfer Pricing Guidelines provide a specific framework designed to adjust for these exact timing effects. The framework relies on a core conceptual formula to determine the total time gap of a company's capital. It is the period needed to sell inventory, plus the period needed to collect cash from customers, minus the period granted to pay debts to suppliers. In a competitive, capital-constrained environment, compensating for these disparate payment terms provides the objective way to validate an arm's-length price. We can test this framework using a hypothetical dataset provided by the OECD. We will look at a tested party, TestCo, and a comparable company, CompCo, over 5 years. The adjustment process evaluates 3 accounts: trade receivables, inventories, and trade payables. Because the TNMM evaluates a ratio, such as earnings before interest and tax divided by sales, the working capital footprint must be measured against that exact same financial base. Here, the appropriate base is sales. This table shows TestCo's Year 1 data: sales $179.5 million, receivables $30 million, inventory $36 million, payables $20 million. Adding receivables and inventory equals $66 million. Subtracting payables yields $46 million. Divided by the sales base, it results in 25.6%. Exactly 25.6% of TestCo's sales revenue is tied up in working capital. This establishes the critical baseline needed for our comparison. Now we shift our analytical focus to CompCo's Year 1 data to run the parallel calculation. Applying the exact same formula to CompCo yields an output of 19.9%. Side by side, this proves CompCo operates with significantly greater capital efficiency than TestCo.
CompCo's data also shows an unadjusted EBIT margin of 1.32% for Year 1. Attempting to benchmark TestCo against this unadjusted 1.32% margin right now would yield a flawed and indefensible transfer pricing result, because it ignores the disparity in their capital efficiency. Subtracting CompCo's 19.9% from TestCo's 25.6% isolates a precise 5.7% difference. Extracting this variance is the required mechanism to make the hidden funding gap mathematically visible. The second step converts this abstract 5.7% difference into a concrete monetary adjustment. This conversion requires the selection of an interest rate. This rate must accurately reflect the time value of money for the specific tested party operating in its local market. In this scenario, TestCo is subject to a commercial loan rate of 4.8%. We calculate the adjustment factor by multiplying the 5.7% working capital difference by the 4.8% interest rate, which equals a 0.27% adjustment factor. Finally, adding this 0.27% directly to CompCo's original unadjusted EBIT margin brings it up to 1.59%. By executing this math, we synthetically burdened the comparable company with TestCo's exact working capital inefficiencies. Alternative calculation models do exist, such as adjusting the results of both parties to a theoretical state of zero working capital, but the underlying economic principle remains identical. The resulting 1.59% figure is no longer an illusion. It is a true apples-to-apples arm's-length margin, ready for rigorous compliance testing. This adjustment is highly precise, but the OECD guidelines demand strict analytical rigor regarding the quality of these mathematical inputs. The first caveat challenges the assumption of relying on end-of-year balance sheet data to measure working capital accounts. If a business is highly seasonal, a simple December 31st snapshot will critically misrepresent its average working capital drag over the course of the year. In these volatile cases, an accurate calculation requires using averages taken across the entire financial year, rather than static year-end numbers. The guidelines also challenge the assumption of utilizing a single uniform interest rate across all asset classes. While applying a single rate is a common simplification, differing asset risks, such as inventory funded by equity versus receivables funded by debt, can demand a significantly more complex multi-rate calculation. Despite their utility, working capital adjustments are never automatic, nor are they automatically accepted by opposing tax administrations. Unilaterally applying these adjustments to salvage poor comparables carries inherent danger. It can increase a multinational enterprise's risk of double taxation if the treaty partner rejects the premise. To mitigate this, tax authorities utilize bilateral safe harbors. This macro-level mechanism preemptively standardizes these adjustments, avoiding case-by-case friction for low-risk entities. These safe harbors lock in acceptable profit ranges between jurisdictions. They prioritize administrative certainty over perpetual, costly audits. The working capital adjustment is a precise and powerful tool, but its implementation requires unassailable economic justification. Mastering this calculation is essential to ensuring your application of the arm's-length principle holds up under the most rigorous international scrutiny.